weeks away from what could be a tightening of 5% in the U.S. GDP. We already saw nearly a month of fruitless discussions. How do you see this panning out?
Well, the thing I think people maybe don't understand is that unless the US government, between the administration of the President and the legislature, the Congress, unless they actually come to a decision by the end of next week, the US economy will basically fall off that fiscal cliff, because they don't have time to draft the legislation before Christmas and before the New Year holidays. So we need to get there pretty quickly. At the moment, I don't see any reason for either side to agree on anything, because if they fall over the fiscal cliff, then taxes will go up and spending will come down. And after that point, it will give Congress a much easier route to a compromise somewhere down the line, because Republicans will be able to claim a victory in lowering taxes after they've gone up. And Democrats will be able to claim a victory in raising spending after it's gone down. So I think we probably are headed over the fiscal cliff in America, and with it will come a pretty negative reaction in markets.
What is your 2013 outlook for the Eurozone crisis? Is the worst yet to come?
Oh, the worst is still to come in Europe. The adjustment process has barely begun there. When we look at overall private credit debt figures, they're down a mere 5 percentage points over the last 5 years. They've probably got to fall at least another 15, 20, 30 percentage points as a percentage of GDP. That's ahead of us for the next 5 to 10 years. The European problems are not going away, they didn't go away in 2012. They're certainly not going away in 2013. If anything, Europe is decelerating into 2013. They still have a currency that most European countries in the periphery can't cope with. It's far too high. So I think the crisis continues into 2013 and gets worse.
Looking at all the factors in the current global economy, how different is your investment approach for the next year?
Yeah, we've been relatively negative on Europe for this year, and that hasn't worked out that well. The German stock market's up well over 20%. That makes no sense in terms of the economic fundamentals. So we would tend to be very short equities in Europe. We'd be short equities in North Asia, places like Korea, Taiwan and China still, and we'd be long equities in Southeast Asia, the ASEAN countries in particular. We're pretty neutral on India, given that it's run so far over the course of the last 12 months, and I think a lot of good news is priced in that might not be forthcoming. But relative to fixed income and gold, well, we're always long gold. As long as we have people like Bernanke printing the amount of US dollar bills that he does every day, you've got to be long hard assets. So gold, energy, agriculturals, real estate, we'd be long all of those physical assets.